Thanks, Judy, and good afternoon, everyone. It's a pleasure to be here. I'm grateful for this opportunity to present to you a vision of the full potential that the capital markets offer to the insurance industry. I felt for some time now that the potential impact of all this capital flowing into the industry has been shortchanged as simply a reinsurance phenomenon. It certainly had a dramatic impact on the reinsurance industry, but that's just the tip of the iceberg. In fact, it can fundamentally change the industry and can have a more meaningful impact on society. To give you a sense of that possibility, let's first look at how the industry works now. The insurance industry's role is to create value by intermediating the transfer of risk from insureds to investors. All the money in the system comes from either the insured, through the premiums they pay, or from investors through the capital they provide. They give this to the industry to in return create value for them. Well, let's see how well it's doing that now. From the insured's perspective, in consumer satisfaction surveys, insurance is consistently ranked among the lowest across industries, somewhere just above the cable guy. Every catastrophic event highlights a significant and growing gap between economic losses and insured losses, what the UN calls a protection gap. And it's not just in emerging economies. Even in California, only 17% of policyholders buy earthquake insurance. In California. Why is capacity constrained and expensive? It's because within an insurance company, the cost of holding risk on its balance sheet is artificially high to begin with. And it increases exponentially as the concentration of risk increases. It also comes from an underwriting mindset that wants to exclude exposures in order to minimize losses, as opposed to a mindset of pricing all risks. I'll expand on both of these issues in a bit, but first let's turn to the investor perspective. It is consistently viewed as lagging other industries in returns. It's capital intensive, depressing returns. Growth prospects are dim compared to other industries, in spite of the large protection gap. Investors don't really understand the underlying insurance risk. They are complex and opaque, until some disaster reveals to everyone, including to management, the latent risk. There are two key factors related to capital that drive poor performance. First is that insurers have a high fixed cost associated with permanent capital. Most of the industry is capitalized by permanent on-balance sheet capital in the form of equity. The result is that it's difficult to flex the capital with swings in market pricing. So when prices soften, there is no tight feedback loop to withdraw supply to stabilize pricing. The pressure to keep writing is great, and pricing continues to soften the market. The supply-demand dynamics have a significant delay. The second factor is due to the inability of investors to convey their return expectations for the various products that have very different risk profiles. As an intermediary, an insurer is supposed to take the price that investors require, given the risk profile of the portfolio, and pass through that price to insurance buyers. The way this works is that investors, the stockholders, send a signal to management of the returns they expect given their perception of the risk profile of the entire company, all the insurance products and investment risk. Management then parses that signal by allocating the risk premium, which is also called the total cost of capital, to all their products to develop product pricing. Each product is allocated a portion of the total cost of capital that it must make as profit, so that the total profit across all products equals the required return. And it takes those product prices to the insurance market. The prism that they use to deconstruct that signal is casually referred to as an economic capital model. Now, anyone who knows anything about economic capital models knows that it relies on and is highly sensitive to the underlying methods and assumptions. I've spent many years working with these models, first as a consultant advising insurance companies, then as a chief risk officer accountable for the work. I've seen all kinds of different methods producing wildly different prices. In fact, these models are quite versatile. In the proper hands, they can produce whatever results you want. Insurers spend a ton of time and money building these models and developing the methods and assumptions. In fact, it's considered a core organizational competency. Yet there is constant disagreement between underwriters and actuarial and risk teams who are supposed to come up with these prices. And so, naturally, there are also differences across insurance companies. The reason for this disparity is that, as economists have pointed out, when it comes to allocation, there is no right objective economic way. It's really a function of your philosophy. So, very different internal prices emerge in the market that are driven by different philosophies of management, rather than return expectations of investors. Each insurer will have underallocated the cost of capital to some products relative to its peers and overallocated to others. Where it's underallocated, all other things being equal, it will attract business and its competitors will feel pressure to lower their prices. And when it's overallocated, it will feel the pressure to lower pricing to compete with others who've underallocated, which then makes it difficult for any insurer to meet the total return expectations across all the products. This lack of a direct mechanism to discover what returns investors, who are the ultimate bearers of risk, expect for products that have very different risk profiles, and relying instead on subjective models contributes systematically to lower returns for all insurers. I've only highlighted a few problems, those that are related to capital that don't get talked about much. But of course, there are many other problems. But I think you get the idea. Even though the industry has served society well for hundreds of years, enabling the industrial age and is a critical component of modern economies, there are still important problems that are creating dissatisfaction among both the insureds and investors. There are many people working on developing new business models for insurance companies that try to address these problems. I think of these efforts as incremental rather than anything fundamental. Many are working on improving the front-end interaction with insureds, but the guts of the industry and the back-end connection to investors remain the same. There are also some working on improving the back-end interaction with investors. However, the front-end product and distribution and the operation of the insurance company remain the same. I think we need to look beyond these incremental efforts that focus on parts of the value chain and instead review the entire value chain from first principles if we want to make fundamental improvements for insureds and investors. It's worth reimagining the entire process of risk intermediation. If we were to start from scratch, what would the insurance industry look like? Let's first see if we even need an intermediary. Imagine if investors could face off against insurance buyers directly in an open market. Then price and capacity would be determined through market forces of supply and demand. That would be the most efficient. But since insurance products vary significantly in terms of their risk-return profile, there can be different markets for different products. However, there are several problems with this model. The first big problem is that it's difficult for investors to assess the risk across the entire range of insurance products. They don't have the information nor the experience to assess insurance risk. The underlying risk factors are very different from the macroeconomic factors that drive most of the other asset classes in the capital markets. So we need someone with specialized expertise in insurance risk to do the risk modeling. Note that I'm talking about risk modeling, not risk pricing. Think of it as developing the expected loss or the full loss distribution for cat bonds. Once the risks are assessed, the information is provided to investors, since they are ultimately bearing the risk, to express their price expectation given the risk profile. The risk modeling can also be of value to insurance buyers. It can provide critical information on how best to control risk pre-event and to control losses post-event. This has been a hallmark of the insurance industry in driving safer practices in both consumer and commercial markets. The second problem is that we need someone to service the risk, meaning contracting, collecting premiums, and paying claims. At this point, this actually looks just like the peer-to-peer models that have emerged in marketplace lending, like Prosper and Lending Club. They've reduced their intermediation role to simply matching up providers of capital with users of capital. There is no warehousing of risk or holding of capital. However, the last big problem with this is that, unlike in consumer finance, insurance doesn't need to be fully funded because of the significant diversification benefits. Investments don't need to equal the total nominal value of insurance limits. In fact, the ratio of total limits insured to amount of capital required can be on the order of 50 to 1 or more, depending on the class of risk. So we need someone in the middle with a balance sheet to provide diversification benefits. Now, it may seem that we're back to the current insurance industry. However, there is a huge difference. The insured does not need to warehouse risk and therefore doesn't directly drive pricing and capacity. It acts as a middleman between investors and insureds to convey information about supply and demand to determine a clearing price. Having gone through this thought experiment, it now suggests what an insurance company should look like and how it should interact with insurance buyers and investors. Let's say that insurance companies create value in two ways, by originating risk and by financing risk. Origination is all about the interaction with insurance buyers and includes all the activities that we just talked about. Financing is all about the interaction with investors. The question to answer here is, where should risk be warehoused to create the greatest value? Or, to put it another way, how best to match up risk with sources of capital? The industry currently presumes that all risk should be warehoused on the insurer's or reinsurer's balance sheet for the benefit of the investor in the company stock. But is that indeed what maximizes value? Well, let's take a look. If I were to break up risk into three categories, the first category is for risks that have high frequency and low severity, like auto. The risk profile is driven by the classic insurance dynamics of the law of large numbers to create low volatility, fairly stable returns. It's the kind of risk profile that equity investors are attracted to. So these risks could stay on the insurer balance sheet and should not require a significant amount of capital. However, their relatively simple risk profile also suggests that they can be easy to securitize and take off balance sheet and allow different investors to specialize in sub-products within this category. In the second category, let's put all the low frequency and high severity risks, like natural catastrophe and other event risks that are uncorrelated to most asset classes. You know the story here. These are systemic risks for the insurance industry because they're typically syndicated across many insurers and reinsurers and are very expensive to warehouse on their balance sheet. They should command a low risk premium, given their low beta to other asset classes, close to zero. However, within an insurance company, these risks first attract a high capital charge from rating agencies and regulators. AM Best is planning on increasing their capital charge for NatCat, and the US RBC model will incorporate an explicit NatCat charge for the first time. Secondly, they also attract a higher cost of capital as they are mixed within an insurance company's portfolio of insurance and investment risk, and investors price insurance company stock at a beta closer to 1. So what should have been a low risk premium attracts an artificially high risk premium and causes companies to limit the capacity they can offer at affordable prices. Transferring these risks to institutional investors who value the diversifying nature of these risks can significantly lower the cost of capital and make cat risk more affordable and help reduce the protection gap. I was in Bermuda last fall at an industry event, and there was a panel of prominent CEOs who were pointing out that the industry has lots of capital and urging everyone to go out there to offer capacity and fill the protection gap. However, they didn't talk about the cost of that capital. The issue is not the availability of capital, it's the artificially high cost of capital. The current IRLS market is a partial evidence of this phenomenon. I say partial because yes, it's lowered the cost of capital, but insurers have not seized on this as a strategic opportunity to transfer out almost all cat risk and provide greater capacity to policyholders at lower cost. Think back to the California earthquake market. It's been viewed more tactically as an opportunity to lower the cost of reinsurance through increased competition among capital providers. That's a shame. Insurers should retain just enough risk to align interests with investors and then transfer all systemic cat risk directly to the capital markets. if it was viewed this way, the cat bond market grow even beyond the 300 plus billion of cat risks that are currently reinsured. Transferring these risks makes sense not only on the basis of lower cost of capital, but since they're systemic to the industry, they're not a good basis for distinguishing performance of one insurer versus another insurer. The primary driver of cat risk is, of course, whether or not there's a cat event. When there isn't an event, it's impossible to distinguish good underwriting from bad. We've not had a major Florida hurricane in many years. Does that make those insurers and reinsurers focused on Florida cat greater underwriters? We don't know. And when a large event does happen, companies normalize their earnings to adjust for cat losses, suggesting that investors not pay too much attention to them. It's rare, and anyway, everyone suffered losses. The third category contains all risks that generate significant cash flows, long-tail business and that generates float. These risks are another source of systemic exposure that is expensive to hold on an insurer's balance sheet. You would think that when you buy an insurance company stock, that you are adding insurance to further diversify your investment portfolio. But if you look more closely at the insurance risk, you will find that about half the risk of an insurance company are not from insurance, but from investments, the same as the rest of your portfolio. Given the amount of float generated, they have no choice but to invest that cash and take financial market risk. But it's inefficient for investors who want exposure to financial markets to take that by buying insurance company stock. It's better to invest directly in the markets. Also, insurers are constrained in their ability to invest in a way that matches the illiquid, long-term nature of the underlying liabilities. A disciplined asset liability matching exercise would certainly suggest investments that are less liquid, for example, real estate, and more volatile, for example, equity. However, pursuing this more aggressive but matched investment strategy on an insurer's balance sheet would attract higher capital charges from rating agencies and regulators that would dilute their additional returns. So again, it makes sense to transfer float business to investors who have a portfolio of financial market risk and would value the long-term illiquid liability stream as a source of diversification and leverage. By the way, none of the current varieties of hedge fund re that have popped up are designed to create value in this way. They're either focused on hedge fund manager objectives of permanent investments, tax benefits, defensive reinsurance strategies, reduction in reinsurance costs, and flexing between insurance and investment risk. Each hedge fund re model certainly creates value for those who created it, but it's not clear that these models are designed to create value in a holistic manner for everyone, insureds, insurers, and investors. Insurer 2.0 would securitize most of its risk, after reflecting the benefit of diversification, into the capital markets and leave only enough risk to align interests in the integrity of the risk modeling. Tactically, it would optimize securitization structures that reflect tax, accounting, and regulatory constraints to achieve the lowest cost of financing. Remember that when risks are retained on insurance company balance sheets, taking on more risk increases concentration and increases costs exponentially. If risks are transferred instead to the capital markets, the vast capacity of the markets to absorb risk concentrations means that taking on more risk increases cost linearly rather than exponentially. That can have a huge impact on origination and the protection gap. Since risks are now warehoused and capacity is much less constrained, it would change the mindset of underwriting. Have you ever wondered why the insurance industry talks of underwriting as risk selection and pricing? We all know what pricing means, but what does selection mean? Once you have the internal price, isn't selection simply taking business that has a market price above your internal price? Actually, no, it's not that. Selection is much more important. In fact, someone who's a giant in the industry, very successful and well regarded, once remarked at a private gathering that I was at that although it's important to develop better pricing models, selection beats pricing every time. Every time. He was conveying not only what he believed, but the sentiment of many who grew up in the industry. In fact, insurance companies are willing to spend more money to get the best underwriters, the ones who do the risk selection, than actuaries, the ones who develop pricing models. and P&Ls are attributed directly to underwriters, and it's often the route to leadership positions. Logically, if selection is more important than pricing, then it must mean that an underwriter is constrained in being able to enforce the company's own pricing. In fact, underwriters are often price takers, so they end up spending a lot of time trying to gather individual account info to find the ones that have the lowest potential for losses. They also use contract terms and conditions to further control the risk and to have as low an exposure to losses as they can get away with. The underwriting mindset is, given the price, how do I minimize losses? As opposed to, how do I assess and price this risk? Their bonuses and livelihood depend on it. Unlike in investments, in insurance underwriting, there is limited upside. The most you can make is the premium. But the downside is practically unlimited. You can lose many multiples of your premium, wiping out the value of the business you have generated for many years. This is how they think. So it's understandable if underwriters become risk averse. As a result, like a banker who only wants to lend to those who don't need the money, the underwriter likes to only insure those who don't have risk. Under Insurance 2.0, however, the underwriter creates value from risk modeling, not warehousing risk. Capital has long become a commodity in most industries. What has stopped it from becoming a commodity in insurance has been the opaqueness of insurance risk. An insurer that can both have a superior understanding of risk and can convey that understanding to investors will be much more valuable to investors and ultimately also to insurance. The success of transferring Nat Cat risk to the ILS market is not surprising. The risk modeling is somewhat standardized and easily conveyed to investors. So the best way to create value is to focus on assessing risk and rating risk for the benefit of investors. The mindset should change to pricing is everything, and insurers can focus on doing what they're in a unique position to do: mine data on claims and risk factors to develop superior risk models. The insurance industry's investment in risk analytics and actuarial science has lagged behind the tremendous growth in the amount and accessibility of data and sophisticated analytics, particularly because of its focus on selection rather than pricing. By singularly focusing on assessing risk and providing that information to the ultimate risk bearers, the industry can help improve the reliability of pricing and better meet investor expectations. In terms of the impact on insureds, contractual terms and conditions would be driven not by a mindset of trying to limit losses by excluding and sublimiting risk given a substandard price that you have to accept, but only with an objective to ensure ability to assess the risk. Only exclude or sublimit risk that you are unable to reliably assess. Let investors dictate capacity. This would allow underwriters to better meet insurance needs of their clients. In terms of the impact on the insurer, since prices would be driven more by investors, there is less systemic risk of underpricing, and underwriters can indeed be compensated based on production. The more risk they can reliably model, the more both insurance buyers and investors benefit, so the more they get paid. This connection between the financing and the back end leading to a change in the mindset in originating risk is critical to create value for insureds and investors. Likewise, there's an opportunity to redesign products on the front end to logically connect to the securitization on the back end. This is why I view many of the piecemeal efforts of startups on parts of the value chain as incremental rather than transformative. It's critical to recognize the value of thinking of origination and financing as an integrated whole. This framework for creating value would benefit all three parties in the value chain of risk transfer. Insureds benefit from the greater capacity at lower cost of capital and more complete coverage. This directly addresses the biggest criticisms they have of the insurance industry. Investors benefit from more opportunities to invest directly in a diversified class and a more direct market mechanism for expressing their risk-return preferences. Capital can flow in and out based on relative returns, and we eliminate this artificial pricing of products based on some abstract notions of risk, and thereby increase the ability of investors to realize their expectations. Insurers, that is their stockholders, benefit from a higher ROE due to a lower capital base and more stable performance. They would be compensated for the value created from risk modeling, which behaves more like a service fee and has less volatility. They compete on their ability to model risk, not the size of their balance sheet and not their subjective pricing models. To start on the path of this transformation, several things need to happen. The first is the recognition that warehousing of risk is a separate and distinct choice by insurers from originating of risk. Value can be created simply from being very good at assessing risk, servicing them, and developing a diversified portfolio, and that value is distinct from the value created from warehousing risk. It requires a change in the mindset and compensation practices of frontline underwriters. What's critical as well is the development of a more sophisticated finance function that creates value by better matching risk to different investors. The emergence of the ILS market has been viewed narrowly as a reinsurance phenomenon, and the reins have been left in the hands of reinsurance buyers. Reinsurance buyers, however, do not typically have a broad mandate to change the entire capital structure and lower the cost of capital. That's the job of the CFO. CFOs have to recognize that they have more tools to optimize their capital structure and lower cost of capital than simply on-balance sheet debt and equity. There is a proliferation of tools in markets for sourcing capital, and they need to take the reins to shape the development of the capital markets. Related to this is the need for improvement in risk transparency and understanding for investors. There are investors willing to invest along the entire continuum of the risk-return frontier if they could rely on a credible, transparent risk rating. Working on simplifying and standardizing risk transfer structures will allow for a much larger base of investors and a lower cost of capital. I realize that this is a tall order for the industry, particularly for one that has weathered many stages of industrial evolution and revolution without any fundamental change. Frankly, I think this change will not happen within the industry, but without the industry through startups. What I'm proposing is not without precedent, and in many ways not even an original idea. Other industries have gone through this transformation. Certainly banks have transformed themselves from holders of risk to originators of risk. Commodities and energy markets have similarly transformed themselves from markets that were once opaque, bespoke, and heavily relationship-based, just like insurance, into markets with price transparency, standardization, and commoditization. And that has been a good thing. What I think is the most important thing to note is that the timing is just right for this transformation in the insurance industry. The unprecedented significant flow of capital and associated infrastructure, creation of funds, securitization techniques, etc., makes the timing just right. Particularly when we mix in the other major dynamic that is starting to affect the industry, the impact of technology and big data. Fintech has certainly started to impact banking by breaking up the value chain and discarding the components not creating sufficient value for the ultimate consumer and investor. The opportunity to combine the use of technology to deliver better user experience, use of big data to improve the reliability of risk modeling, and the use of capital markets to price and warehouse the risk makes now the perfect time for disruption of the insurance industry for the benefit of all. I've heard many times that insurance is not sexy and doesn't attract millennials. I agree with that, but what I think is sexy is disrupting major industries to forge a new path for the benefit of society. This is the opportunity that exists for the insurance industry, and it is already starting to happen.